that because not the entire 43 goes to OCI, only, I mean, out of the 43, 20 goes to OCI and only 23 goes to POL. Hence the reason why what we are adding back is that. And that is like depreciation, it doesn't involve. Everything we're adding back, we are adjusting there is because they do not involve movement of cash. Share of profit of associate, when you are explaining it, you may want to say what involve movement of cash, like dividend, like additional investment made during the year by way of cash, like this. But share of profit of associate is not the cash. Goodwill impairment, of course, just like the other impairment here, you explain why you're adding in back service cost component. And you should equally talk about this adjustment to working capital items as well. So basically, they want you to talk about. Then that will give us how many months? That will give us just 12 months, just 12 months since 1131, right? Should we continue? So that when we come back, we only do the.
So let's continue.
Yes, sir.
I won't continue.
Let's continue.
Okay, no problem. Okay, so in this other part of the question, right? Again. Let's look at what happens in these changes in group structure that they're talking about here. They said during the year, ended 30 September 20x8. So the first and foremost, explain how the changes to the group structure, right? And dividends, how the changes in the group structure, right? And dividend will impact upon the consolidated statement of cash flow as at this date, right? For the Moyes Group. You should not attempt to alter your answer to part A. What we are discussing here, we should not alter it, but we should take it in isolation. Okay, let's look at what happened. During the year ended 30 September 2018, Moyes acquired a 60% subsidiary, acquisition of subsidiary during the year, and the name is Davenport, and also sold all of his equity interests in Baham for cash. Both of them for cash, Abi? No, let's listen first. The consideration, Baham for cash, right? Baham for cash. The consideration for Davenport consisted of a share-for-share exchange. Are we together? Together with cash payable in 2 years. So that means it's Baham that this cash are elected in yellow relates to. The consideration paid, remember, is this company that acquired Davenport, right? And they said the consideration consists of share that of his own that it has issued, and what? A cash consideration to be paid in 2 years' time. 80% of the equity shares of Baham had been acquired several years ago. Okay, that is Baham. So we are done with Davenport. So it's Baham they are talking about now. 80% of the equity share of, okay, but consisted of, okay, 80% of the equity share of Baham had been acquired several years ago, but Moyes had decided to sell as the performance of Baham had been poor for a number of years. It's been poor. Consequently, Baham had a substantial overdraft at the disposal date. Substantial overdraft. So this guy is a liability to the group. As it's going, he's carrying his liability away, right? It's not that it's carrying positive cash away, it's carrying liability away. I'm sure as I'm emphasizing this thing, your mind should be going back to what we discussed. when we talked about acquisition and disposal of subsidiary during the year and the impact on the statement of cash flow. At the disposal day, Baham was unable to pay any dividend during the financial year. He could not pay any dividend, and so what? But Davenport did pay an interim dividend on 30th September. Okay, now. So there are three things that happen here. Acquisition of Davenport. Consideration is not in cash. It's in form of shares, and it's in form of deferred consideration to be paid in cash in 2 years. That is one. Number two, disposal of Baham. They say that one is cash, right? You know, when a subsidiary is leaving you, you will know the assets and liabilities is going with, right? One of them could be cash, but they said this Baham did not go away with cash. It went away with overdraft because what he had before was not a positive cash, but an overdraft. Number three, they talked about payment of dividend. They said, who is that? The one that was acquired did not pay. Okay, Baham, the one that was sold, did not pay dividend. But Davenport paid an interim dividend. Davenport was on how many percent? 60%. That means NCI is what? 40%. So what is the impact of the group, of the changes in the group on the statement of cash flow? And what is the impact on the dividend on the group statement of cash flow? Let's talk about impact on the acquisition of Davenport. How does it affect statement of cash flow? Group statement of cash flow. Tell me. Davenport. How does it affect statement of cash flow? Tell me. For a day that.
So the acquisition of a subsidiary, for cash, when you acquire a subsidiary using cash, the net amount paid would would reflect in investing activities. And when I say net amount, it will be the amount paid less the cash balance of the subsidiary acquired, cash and cash equivalent. Yeah.
Okay. Continue. You know what you've explained now is what the standard says, that when you acquire a subsidiary during the year, the cash you paid, say 100 million, less the cash that subsidiary brought in, say 10 million, which is 90 million. That 90 million should be shown as an outflow of cash under investing activities. That is what the standards say that you have just explained. Now, related to this, related to Davenport acquisition. Because you have to relate it to it. You can't just explain what the standard they say without relating it. That is the point I've emphasized to you guys. Related to Davenport. Was cash paid to acquire Davenport?
No.
Cash wasn't paid. The consideration is in form of shares and deferred consideration. So no cash out. They did not tell us the cash that subsidiary Davenport brought in, but you should be able to mention it, that given that no cash consideration was paid, are we together? Are we together?
Yes.
No, I said the other time that if you paid cash of 100 million, less 10 million that the cash that subsidiary brought, you say 100 million, the cash you pay, minus 10 million, the cash that subsidiary brought in. It means the net cash you paid is what? Is 90 million. That is an outflow of cash under where invested, right? But this subsidiary, we did not pay cash. If it came in with a cash, say 10 million, are we together? And we did not pay cash, the cash we paid is zero. That means that zero cash that we pay minus that 10 million, which is positive 10 million now, that is going to go under investing activities. Are we together? As an You will call it acquisition of a subsidiary. Instead of you to say cash paid, it will now be net cash inflow, which is 10 million. Are we together? In my own days, when I was attending this type of question, when I explain it, I will now give, for example, the same way I've used example for you. For example, if given that no cash consideration was paid, if on acquisition of that subsidiary Davenport, the cash it has in its book at the date of acquisition was 10 million, then that 10 million will be presented under investing as cash received on acquisition of the subsidiary. You are supposed to pay cash. It should be net cash paid, but this time around it's cash received. So I use an example when I was writing in those days, and I think there's nothing wrong if you do that. So that is explaining the acquisition of Davenport now, how it will affect statement of cash flows. Correlated that maybe you had a network challenge then and you couldn't answer, but I think I've dealt with that. Let's deal with disposal of Davenport. I mean of Baham. We disposed Baham for cash, right? Are we together? Who want to explain this? Who want to explain this disposal of a subsidiary during the year? Anybody? Anybody? Okay, let me explain it myself. When you sell a subsidiary during the year, right? Osaratin, are you asking a question or you want to explain?
I wanted to explain, but you can go ahead since you're said.
Okay. When you dispose a subsidiary during the year, are we together? Say the sales proceed is 100 million. But that subsidiary you sold is going away with a cash of say 5 million. Are we together? From the group perspective, proceed from disposal will be the 100 million cash you receive. Are we together? Less that 5 million that subsidiary is going with. And that will give you what? 95 million net proceed. To be presented on that way, under investing activities. We've been told that the proceed here is cash. They did not mention any amount, right? But you can use example just to buttress your point. But don't write too much, even in that using that example. However, this subsidiary that is going away called Baham does not even have, it doesn't have positive cash at the day it's going away. It has an overdraft. Let's say that overdraft is 20 million. Are we together? You know, I say if it were to be positive cash, you say proceed 100 million less cash of 5. So net proceed is 95. But when what the subsidiary has is an overdraft of 20, and you have received 100 as proceed. You know, when you say minus, because the overdraft is minus, it turns to plus. So if the overdraft of that subsidiary as the day is quitting the group is 20 million. Rather than deducting it from 100, you had it. That means you have 120. That means the group position, cash position, will improve by the exit of that subsidiary because what it has before is an overdraft. So under investing, you will now say proceed from disposal of a subsidiary, positive cash of how much? 120. So you need to do that explanation to that extent, that subsidiary that has an overdraft that is leaving the group is going to make the group cash position to improve by whatever is sitting there in its overdraft in addition to the cash received. So you need to take that explanation to that point. Please, ladies and gentlemen, the explanation should also go to the extent of both for Davenport that was acquired and Baham that has been sold. Based on what you and I did together, the explanation should go to the extent that when you are looking at the movements in the assets and liabilities during the year, say PPE, you need to recognize the fact that a subsidiary Davenport came in during the year and they brought a PPE at fair value. You need to plug in that fair value in that PPE working. You need to recognize the fact that you sold Baham during the year. It went away with PPE. You need to plug in that PPE in that reconciliation, such that when you are trying to determine true cash movement by way of addition to PPE for cash, you'll be able to derive the correct figure. You'll be able to derive the correct cash flows. So you need to take that discussion to that extent. I recall for those who attended the online class, I demonstrated this and I used example in Excel. I thank you. The last part of the discussion they want us to do is dividends. Davenport was acquired during the year, and we are told it paid an interim dividend. They did not mention any amount. But I like to use illustration to make the point known. And I told you I've done this in the exam. And there is nothing wrong if you do it, if you use example where figure is not given, so that the examiner will know you know what you are talking about. So no amount was mentioned regarding the dividend paid by Davenport during the year, right? Assuming Davenport paid a dividend of $10,000. Remember, Davenport is owned by this parent company to the tune of 60%. That means 60% of that 10,000 will have been received by the parent company, which is 6,000, right? Right? Egere, are you still with me?
Yes, sir. Yes, sir. Yes, sir.
And the balance of 40%, which is 4,000, will have gone to who? NCI. Okay. Can somebody tell me how that dividend will impact group statement of cash flows? Using that my example, how will it impact group statement of cash flows? Did you get my example? Assuming the 10,000 is dividend paid by David. Hey, listen and listen good though. Listen and listen good. Assuming they said dividend paid an interim dividend, is that not? Did they give us an amount? No. I'm assuming a figure just to illustrate so that I can confirm that you truly get this thing. Assuming dividend, interim dividend paid by Davenport, which is owned by the parent company 60%, is 10,000. How much of that dividend of 10,000 will have been received by the parent company? Tell me. How much of that?
6,000.
The balance of 40% goes to who? NCI, not controlling interest, and that is 4,000. The question here is simple. What will be the impact of that on the group statement of cash flows? Explain. That is what they want.
We would remove it from cash flow from financing activity.
How much? How much are you removing?
We are removing the NCI portion. That's 4,000.
The 4,000 paid to NCI. The 4,000 paid to NCI.
You will present it under financing. That is what you said. as dividend paid to NCI of how much? 4,000, right?
4,000.
4,000.
What about the portion received by the parent company? You should explain that. If that is not going to have impact on the group statement of cash flow, please explain that as well. How will you explain that?
That one constituted intercompany.
Okay.
That would be under investment
Dividend
activities.
of 6,000, are we together? Paid by the subsidiary to the parent, are we together? Has no impact on the group statement of cash flow because it's as good as if you have paid yourself dividend. Remember, in the group account, the parent and the subsidiaries are the same. So dividend paid to yourself, why will you show it to the world that you have paid yourself dividend? Because dividend paid by the subsidiary to the parent is as good as dividend paid to yourself. You cannot show that in the statement of cash flow. There is no cash that moves. It's like taking cash from your left pocket and you put it in your right pocket. It's still in your pocket, it's still with you. So that is eliminated on consolidation. So the only amount that will be shown is that dividend paid to NCI of 4,000 using that example. And I've told you there's nothing wrong if you use a figure, even where none is used, to explain a point in a way that it's not compulsory. It's not compulsory to use figure where none has been used. So that is about that. Discontinued operation, Martina.
Just a quick question. Dividends, are they shown under financing or investing?
Dividend paid is shown under finance. Dividend received according to the standard, depending on the entity. For other entities other than those that financial institutions, it says you can show it under operating or under investing. That is dividend received. But oftentimes we show dividend received under invest. But dividend paid is purely financing.
Okay. Then, sir,
Thank you.
another question. Sorry, sir, another question. Just one more. So I understand the net impact, right, of the dividend paid to the group. Will it be wrong if we say under financing we'll show 10 paid out, and then under investing we'll now show the 6 as an inflow?
No, you can't do that. Don't do that. Okay, don't do that. Because if you do that, the question is that 6, who paid you that 6? You say you pay yourself. That is why you are showing it as an inflow under investing.
But for presentation's sake.
For presentation's sake, based on what you consider to be right in your judgment. But you know, in the format I gave to you, I never put it that way. And the standard never says you should put it that way.
Okay, sir.
So don't put it the way you are thinking. Okay. Korede.
Okay, so the question I want to ask is not directly related to this question. I don't know if you can answer me now or later. So, what would be the impact of a lease arrangement on the cash statement of cash flow? Lease arrangement, because there are a lot of figures that comes in when we are accounting for these arrangements.
Korede, you were in the physical class, right?
Yes.
Because I explained this when I was taking good statement of cash flow in the online class. Listen and listen good. For leases, are we together? Periodic payments consists of interest and what? Principal. You are a lessee. We are looking at you being the lessee now, right? As a lessee, the periodic payment you are making, are we together? We are assuming you are not using the exceptions, the low value exceptions. We are assuming you are not using short-term lease exceptions, right? Meaning that you've recognized lease liabilities and you've recognized right of use assets. The periodic cash payments you are making, maybe monthly, yearly, or half yearly, consist of interest and principal. Are we together? The interest portion, according to IAS 8, except for financial institutions that must present their own, of course, this is a lease. Typically, interest paid, the standard says you can show it under operating or under financing. Oftentimes, we show interest paid under operating. However, for the principal portion of that periodic payment, that is purely under financing. Are we together? That is purely under financing. Another type of cash flow. You know, in Nigeria, you can pay for lease for the entire duration of lease at once. That means there won't be lease liability, right? There won't be lease liability.
Yes.
This period is 10 years. Because we have money too much in this country, we can pay for the entire 10 years in advance. You know there won't be lease liability in that case. The accounting entry will be credit cash and debit right of use asset. Are we together? The question is,
Yes.
that cash for 10 years that you have paid at once, where will it be shown in the statement of cash flows? It will be shown under investing as an outflow of cash under investing. This area, some people have debated it. Are we together? But me, I belong to the school of thought that says it should be shown under investing. Also, when you remember, you were told in IFRS 16 that you may still have periodic payments, but you could have the initial lease payment paid at the lease commencement date or near that lease commencement date, other than the periodic one you will pay later. The one you pay at the lease commencement date, what should be the treatment in the statement of cash flows? First and foremost, what is the treatment of the cash amount paid on the lease commencement date or around that date, according to IFRS 16? When you debit right of use asset, where do you credit? You credit cash. That one does not affect liability. You credit cash. So it's between cash and right of use asset. So synonymous with the cash that we pay for 10 years in Nigeria, when we pay for the entire lease period, so that there is no lease liability. That cash that you paid on that day one, that you credited to cash and debited to right of use assets, that cash should equally be presented under investing activities. So I've taken it from the perspective of the lessee, and that is it. I don't know whether I've answered your question.
Yes, you have. Then the depreciation that you charge on right of use
Right
assets
of
will
use
adjust our operating profits.
Just like any other
The
depreciation.
profit before tax. Thank you, sir.
Yes. Just like the depreciation for PPE. Thank you. Bukola. Bukola, you are still muted. Can you unmute yourself and speak, please? Bukola, you are muted. Can you unmute? Okay, maybe due to a network issue, when you are able to unmute yourself. Okay, let's quickly look at the C part of this question. Bukola, unmute yourself. You are just going off and on. Okay. The directors of Moyes wish advice as to whether the disposal of Baham should be treated. Okay, wait. What is the requirement? Advise the directors as to whether Watson should be classified as held for sale and whether both Watson and Baham should be classified as discontinued operation. IFRS 5 at play here, right? IFRS 5 at play here. The directors of Moyes wish advice as to whether the disposal of Baham should be treated as what? Discontinued operation, and separately disclosed within the consolidated statement of P&L. There are several other subsidiaries which all produce similar products to Baham and operate in a similar geographical area. Are we together? Additionally, Moyes holds a 52% equity interest in Watson. Watson has previously issued share options to other entities which are exercisable in the year ending 30 September 2009. That is a year after the year we are looking at. It is highly likely that these options will be exercised, which will reduce Moyes' interest to what? 35%. Remember what they say about the options issued by Moyes? It wasn't issued to, by Watson. It wasn't issued to Moyes. They say it was issued to other entities, other investors. Which means if they exercise their right to get additional share in Watson, they will increase their shares, but Moyes will not be able to increase his own shares because he did not hold that share option. As a result, his own stake will reduce to 35%. Not because he's selling his stake, but because other people are increasing their stake. And he is just looking, because he doesn't hold. The directors of Moyes require advice as to whether this loss of control will require Watson to be classified as held for sale and classified as discontinued operation. Let's first look at Baham. If you look at it, for Baham, they only want to know whether it should be classified as discontinued operation. But for Watson, are we together? Because of the possibility of losing your stake, the highly likelihood of losing your stake such that you reduce your stake, you lose control. Because when you reduce it from 52 to 35, you have lost control. Can you now carry it as held for sale, disposal group held for sale, in addition to what? Classifying it as discontinued operation. What do you think of Baham? What do you think of Baham? Can it be classified as discontinued operation? That is the only thing they want us to say. Ladies and gentlemen, you must remember the definition of discontinued operation as per IFRS 5 for you to be able to tackle this. Because that definition will help you to know whether Baham will meet that definition of a discontinued operation. Remember, discontinued operation has to do with how an entity or a segment of the business should be presented on the face of the statement of P&L. However, held for sale has to do with presentation in the statement of financial position. For Baham, what do you think? What do you think?
Okay, let me give it a shot. I think it's.
Go ahead. Go ahead.
Okay, so I think it should not be. I think it should not be classified as discontinued operation, given that there are other there are subsidiaries that produce similar products. Hello?
Yes, continue. And with you, it shouldn't be classified as
sorry.
discontinued operation because
Yes, there are other subsidiaries that also perform the same operation, and they are in similar geographical area. So I feel it should not be classified as being a discontinued operation, since the entity is still performing that sort of operation.
okay.
Yeah, so that's it.
Who spoke? Is it Korede or Hafiz? Because I could see. Okay, that is Hafiz, right? That is Hafiz, right?
Can I go on? No.
No.
Can I go on?
Okay. Go on.
Yeah, I feel it shouldn't be classified as head for sake, due to the fact that both the subsidiary they are part of the group before the control is actually lost. And I can't remember if it was explicitly stated in IFRS 5 that when you are likely to lose a subsidiary towards the during the year, that it should be classified as head for sale. No, but the only guideline I can actually say is that of the conceptual framework, that whenever you lost control, probably during the year also, the asset and liability of that subsidiary should be derecognized.
Okay, thank you. So let's look at it this way. Let's first look at discontinued operation, which is presentation on the face of P or L with regards to the two entities, because that is what they are asking. But let's take it one after the other. Before we take each entity, how does IFRS 5 define a discontinued operation? I'm sure you did it, right? As contained in IFRS 5, right? A discontinued operation is a component of an entity which either has been disposed of, you have sold it. It's either you've sold it or you've not sold it. It's classified as what? Held for sale. So either you've sold it, Baham has been sold, right? Or you've not sold it, you classified it as what? Held for sale. Watson has not been sold, right? But that definition does not finish there. It now says, and it represents a major line of business or geographical area of operation. There are about three things given in the standard. It represents either a major line of business or geographical area of business or of operation, or it's a single coordinated plan to dispose of a separate major line or area of operation, or it's a subsidiary that is acquired exclusively with the intention to resell. So, for an entity to meet the definition of a discontinued operation, it must be either a subsidiary you sold or you've not sold it, but you've classified it as held for sale, and it should meet those other criteria, right? If you look at Baham, it's been sold, right? To that extent, you may be thinking it should be a discontinued operation, right? But if you look at what is clearly stated in the question, in terms of his product, right? There are several subsidiaries which all produce similar products to Baham and operate in this same geographical area. So does it represent a separate major line of business? Does it represent a major line of business? Given that what is doing, what is producing and selling, there are several other subsidiaries that are producing and selling the same thing.
No.
Or in terms of where it operates, it says it represents a major line of business or geographical area of operation. It may not be. It could be that it's the only one operating in Asia, which is a continent, but still producing the same thing that the others are producing. If that is the case, then it may meet the definition of a discontinued operation. I don't know whether you get that. Looking at the fact that it produces and sells what others are selling, yes, you will say that, but to that extent, it may not represent a separate major line of business. But in terms of its strategic location, if it does operate only in a particular continent, say Asia, it may mean. But here we are told that what it produces is similar, and where it operates is similar to the geographical area where the others are operating. So, although that definition may be seen as being a bit subjective, materiality may be considered at the end of the day in determining whether or not Baham should still be presented as a discontinued operation. Materiality may be considered, especially if the other ones in the same areas or the other ones that are producing and selling the same product as this Baham, if they constitute just 10% and Baham alone constitute like 90%, are we together? Despite the fact that there are other subsidiaries selling the same thing and there are other subsidiaries in the same location, you may go ahead on the basis of materiality to present it as a discontinued operation. But no information is provided in this question, right? As to materiality of Baham in relation to those other ones. You can make use of that point. You now say otherwise, then it will not constitute a discontinued operation. That is, if it's not material. So you can bring in that materiality aspect, because looking at that definition is not likely to meet the definition of a discontinued operation. But you can say despite that, if it's considered to be material, then management may consider presenting it as such. Let's now go to Watson. Are we together? For Watson, they are equally interested in whether Watson should be presented as a discontinued operation. But in addition, they are interested in whether Watson should even be classified as held for sale. If you look at the definition of discontinued operation again, it says it's a component of an entity that has either been sold or is classified as what? Held for sale. Watson has not been sold, right? That means before you can even think of presenting it as a discontinued operation, it must first qualify to be presented as what? Held for sale. So for Watson, let's leave the discontinued operation first. Let's tackle whether it could be presented as held for sale. Let's tackle that first. If I may ask you, can it be presented as held for sale? What do you think? Can it be presented as held for sale? Afif?
Yeah.
Like,
Yes. I don't think it should be presented because if we look at the guidance of IFRS 5, there are some criteria that has to be met. So if we read further and check out for this criteria, so if it actually met the criteria, then we can. But from the question I'm looking at here, it does not meet those criteria.
Okay, fantastic. But in the exam, this is the way you should tackle it. Yes, IFRS 5 requires that an asset or a disposal group should be presented as held for sale if two criteria are met. One, it is available for sale in its present condition. That is number one, right? Number two, the sale is highly probable. The sale is highly probable. Then that sale is highly probable. You know, it has about 5 children, right? It has about 5 children. You
Yes,
know
sir.
what I mean by 5 children?
Yes, sir.
Okay. It has a point. One of those 5 children is
They go born the
management is
children.
management is committed to a plan to sell. It is unlikely they will withdraw that plan. Another one is that sale is expected to be completed within a period of 12 months from the date of classification. Another one is the asset is being marketed for sale at a price that is reasonable in relation to its fair value. In this question, do you mention all those children? Do you need to mention all those children? The answer is no. I'm just mentioning to you. If you say that according to IFRS 5, an asset or disposal group should be classified as held for sale if it is available for sale in its present condition and the sale is highly probable, that is fine. What you now need to do is, are we dealing with Watson as an entity that is held for sale? The answer is no. What is the case with Watson? Watson unfortunately has issued share option to other shareholders. And next year, when they exercise their right, I may lose my control as Moid. I may lose my control. But I'm not losing my control because I'm going to sell. I'm likely to lose my control because when those people exercise their right, are we together? Then I've lost my control because my percentage will reduce to 35%. Does IFRS 5 makes reference to a situation where a control is going to be lost? It will be classified as held for sale. IFRS 5 doesn't make reference to loss of control. Are we together? It does not make reference to loss of control. What IFRS 5 says is, sorry, IFRS 10, consolidated financial statement. It says when you lose a control of a subsidiary, are we together? You must derecognize all the assets, derecognize all the liabilities, stop recognizing NCI, determine profit or loss on loss of control, and recognize it in the financial statement. That is what IFRS 10 says. That when you lose a control, they recognize all the assets of that subsidiary. Hello?
Hello, sir. Hello, sir. Please, please help us repeat what you just said now so that we can.
That is what I'm repeating now. IFRS 10 says when you lose control. I'm only making reference to IFRS 5. I've already explained previously that IFRS 5 does not make reference to loss of control, and it does not equate that with plan to sell. So I now said the only thing IFRS 10 says is when you lose a control of a subsidiary, are we together?
Yes, sir.
Do you recognize all the assets of that subsidiary from your group account? Do you recognize all the liabilities of that subsidiary from your group account? Do you recognize any NCI you may have on it? Whatever be the profit or loss on that loss of control is recognized in your financial statement. Now, the question then that follows is this. When a parent is committed to losing control, I'm committed to losing a control. Are we together? Can I still classify that subsidiary as held for sale? Ladies and gentlemen, you know IFRS 5 recognizes the fact that, yes, it does. It does. It's there in the handout. It's the last part of the handout I didn't talk about. And a subsidiary you acquire with the intention of selling within the next 12 months. Did you hear that? A subsidiary you acquire with the intention of selling within the next 12 months, according to IFRS 5, meets the definition of a disposal group held for sale. Did you hear that? This guy is not committed to. Hello? A subsidiary acquired with the intention of being sold within the next 12 months. A subsidiary you acquire and your intention is to sell it within the next 12 months after the date of acquisition meets the definition of what? A disposal group held for sale. IFRS 5 says that. So it means, when was Watson acquired? Do they tell us? Do they tell us?
No.
We're not told.
Yeah.
We're not told. So you can add that to, so this Watson, this guy is not committed to sell, or he's not committed to losing control. It's not as if deliberately is holding it with the intention of selling within the next 12 months, of losing control within the next 12 months. So, but if it were to be a subsidiary that is acquired with the intention of losing control within the next 12 months, that will meet the definition of a disposal group held for sale. Are we together? And if that happens, that it meets the definition of a disposal group held for sale. Are we together? That means it has crossed that hurdle of meeting, of possibly, let me retract, of possibly meeting the definition of what? Of a discontinued operation. This one are the additional things you will talk about. That is, if it were to be a subsidiary acquired with the intention of losing control within the next 12 months, then it will qualify to be treated as a disposal group held for sale. So going back to the definition of discontinued operation, you know, it says a component of an entity that has either been sold or is classified as what? Held for sale. So if it crosses that hurdle of being classified as held for sale, the next question then is, does it meet the definition of discontinued operation? We will now begin to look at, does it represent a separate major line of business or geographical area? Is it a single coordinated plan to dispose? Or is it a subsidiary acquired, okay, with the intention of selling? Of course, if it's a subsidiary acquired with the intention of losing control, then it will meet it. It will meet it. If it's a subsidiary acquired with the intention of losing control, given that you are expected to do that within the next 12 months, then it will meet it. Okay, that is all about that. Martina, your hand is up.
Yes, sir. So my question is on this subsidiary acquired exclusively to sell. So is it acquired exclusively to sell or to lose control? Or are they the same thing?
Selling 100% or selling partially to lose control mean the same thing in this context. Did you get him, Martina? I understand.
Yeah.
When it says selling, is this selling 100% or is this selling partially?
Mm,
Such that you lose control, it becomes an associate or it becomes
yes.
ordinary. Selling in this context means selling to lose control. Whether it's full
Okay.
disposal or it's partial disposal where control is lost, is the same thing in this context.
Okay,
Okay,
sir.
that is
Thank
the
you.
end of that. That is the end of that question. You are welcome. 12:36. I still want us to go on break. I want us to go on break.
So if we go on break,
Can
then
we
we're not
go
coming
on?
back again
Sir,
now.
sir, let's continue like this. Oh. No time. Oh.
Sir, if we go on break, when are we coming back? There's no point
Okay.
now. Let's just continue and finish.
Let's do 5 minutes. 5 minutes biological break.
Okay.
5 minutes biological break. By 12:32, I will continue. 12:32, I will continue. 5 minutes biological break. At least we should stand up to stretch our leg and our back. It's 12:32 now. We are back in the class. We are back. 5 minutes leg stretch is over. 5 minutes leg stretch period is over. Can somebody quickly help us read this question? We do not have time anymore. Who is helping us with it?
Okay, let
Who
me
is
go.
helping us?
Can you hear me?
Yes, go ahead.
Hello?
Go ahead.
Yeah.
Go
Cabis
ahead.
Cabis is the parent company of an international group, which has a presentation and functional currency of the dollar. The group operates within the manufacturing sector. On 1st January 2002, Cabis acquired 80% of the equity share capital of Bike Light, an overseas subsidiary. The acquisition enabled Cabis to access new international markets. Cabis transferred surplus work in progress to Bike Light, which is then completed and sold in various locations. The acquisition was not as successful as anticipated, and on 30 September 2006, Cabis disposed of all of its holding in Bike Light. The current year end is 30 December 2006. Backlight trading information. Backlight is based overseas, where the domestic currency is the dinar. Staff costs and overhead expenses are all paid in dinars. However, Backlight also has a range of transactions in a number of other currencies. Approximately 40% of its raw material purchases are in dinars and 50% in the yen. The remaining 10% are in dollar, of which approximately half were purchase of material from Cabis. The ratio continued even after Cabis disposed of its shares in Bike Light. Revenue is invoiced in equal proportion between dinars, yen, and dollar. To protect itself from exchange rate risk, Bike Light retains cash in all three currencies. No dividends have been paid by Bike Light for several years. At the start of 2006, Bike Light sought additional debt finance as Cabis was already looking to divest. Funds were raised from an issue of bond in dinars, none of which were acquired by Cabis. Acquisition of Bike Light. Cabis paid dinar 100 million dinar for 80% of the ordinary share capital of Bike Light on 1st January 2002. The net asset of Bike Light at this date had a carrying amount of dinar 60 million dinar. The only fair value adjustment deemed necessary was in relation to a building, which had a fair value of 20 million dinar above its carrying amount, and a remaining useful life of 20 years at the date of acquisition. Cabis measured NCI at fair value for all acquisitions, and the fair value of the 20% interest was estimated to be 22 million dinar at acquisition. Due to the relative poor performance of Bike Light, it was decided to impair goodwill by 6 million dinar during the year ended 31st December 2005. Rate of exchange between the dollar and dinar are given below. At 1st January 2002, we have 0.5 dinar to a dollar. Average rate for the year ended 30th December 2005. We have 0.4 dinar to a dollar. So at 31st December 2005, $0.38 to a dinar to a dollar. Then we have 30th September 2006, 0.35 dinar to a dollar. Average rate for the 9th-month period ending 30th September 2006, 0.37 dinar to a dollar. Disposal of Bike Light. Cabis sold its entire equity shareholding in Bike Light 30th September 2006 for $150 million. Further details relating to the disposal are as follows. Carrying amount of Backlight's net asset at 1st January 2006 was 48 million dinar. Backlight loss for the year ended 30th September 2006 was 8 million dinar. Cumulative exchange gain on Backlight at 1st January 2006 was $74.1 million. Non-controlling interest in Backlight at 1st January 2006 was $48.8 million. Required. Prepare an explanatory note for the director of CABIS, which addresses the following issues. 1. What is meant by an entity's presentation and functional currency? Explain your answer with reference to how the presentation and functional currency of Backlight should be determined. You have 7 marks for that. 2. A calculation of goodwill on acquisition of Backlight and what the balance will be at 30th September 2006, immediately before the disposal of the shares. Your answer should include a calculation of the exchange difference on goodwill for the period 1st January 2006 to 30th September 2006. An explanatory note. 3. An explanatory note of your calculation of goodwill and the treatment of exchange difference on goodwill in the consolidated financial statements. You do not need to discuss how the disposal will affect the exchange difference. Note, any workings can either be shown in the main body of the explanatory note or in an appendix to the explanatory note. D. Explain why exchange difference will arise on the net asset and profit or loss of Backlight each year, and how they would be presented within the consolidated financial statement of your answer. Okay, for certain, your answer should include a calculation of the exchange difference, which will arise on translation of Backlight, excluding goodwill in the year ended 30th September 2006. 7 mark. C. Calculate the group profit or loss on the disposal of Backlight. C2. Briefly explain how Backlight should be treated and presented in the consolidated financial statement of CABIS for the year ended 30th December 2006.
Okay, thank you. Thank you very much. 30 mark question, ACC pass question for SBR loaded. Okay, so let's quickly look at the A part of the question. Let's see how far we can go before we decide to end the class. The A says prepare an explanatory note for the directors of CABIS which addresses the following issues. Right? Okay, so let me go and open another Excel. Okay, what is the name of the company we did here, sir? Moye. So I'll call this one Moye. Then let me move this double entry here. Bring another one here. This one is CABIS. CABIS. Is it CABIS or CABIS? No. CABIS, right? As usual, I will move more, and I will, depending on how many I will need later. Okay. So the A part of the question. You put explanatory notes for the directors of cabbies. For the directors of cabbies. Okay. The A1, we should address what is meant by an entity presentation and functional currency. Explain your answer with reference to how the presentation and functional currency of backlight should be determined. Okay. Okay. Explanation of functional and presentation currency with reference to how the functional, is it both functional and presentation? Functional and presentation currency of backlight should be determined. Okay. Ladies and gentlemen, if you go back to the question, the A1 is clear in terms of what it's asking us, right? They want us to use our knowledge of the fact that we've done IS 21, the effects of changes in foreign exchange rate, to determine, to do what? To explain functional and presentation currency. Ladies and gentlemen, what is functional presentation currency? The currency in which the financial statement of an entity is presented. The currency in which the financial statement of an entity is presented is what we call presentation currency. And that is very easy to define. That is very easy to define. Okay. They now say we should make reference to what? Reference to how the presentation and functional currency of backlight should be determined. Now I'm still dealing with presentation currency. Presentation currency. I've said the currency in which you present your financial statement is the presentation currency. They now say based on that, we should make reference to how the presentation currency of backlight should be determined. What do you think? I want anybody to deal with this. How do you think the presentation currency of backlight should have been determined? How do you think it should be determined?
Oh,
Hello?
yes, sir. So based on the functional currency definition, it is the currency of the primary economic environment of the entity. And there are 5 factors we have to consider, the 3 primary factors and the 2 additional secondary factors. Yes, sir.
Martina, before you go further,
yes, sir.
We should explain functional currency, we should explain presentation currency. We should now make reference to how the functional currency of backlight should be determined. We should make reference to how the presentation currency of backlight should be. So I started with presentation currency, and I have said is the currency in which the financial statement of an entity is presented.
Yes, sir.
I now say with reference to backlight, the presentation currency of backlight be determined. I'm still talking of function of presentation. I'm not talking of functional.
Okay. Well, presentation currency should be, like you said, the currency in which it is presented, and it should be based on the. So we should look at it as if it is a subsidiary, like if it is a subsidiary that does not have autonomy from the group. If that's the case, it should take the presentation currency of the group as its own presentation currency, or it can it should take the presentation currency of the country in which it is located, like in Nigeria, like you rightly explained. The presentation currency of every entity in Nigeria should be the naira. So
We all agree with Martin.
I would like to add something. I'm not sure if it's correct though, but I think the presentation currency should be based on the financials of the company.
Is a
What do?
subsidiary.
So I think presentation currency is a choice by the entity itself, and it's not dependent on, the only thing it's dependent on is on local regulation. Other than that, I think it's a choice.
Thank you, Tokwe. What Tokwe said is what I go with. Presentation currency is a choice. Are we together? You are at liberty to determine in which currency you present your financial statement. Subject to two things in this case. Is there any local regulation? If the answer is yes, you must follow that local regulation. In Nigeria, is there a local regulation? The answer is yes. The Financial Reporting Council of Nigeria has a rule that makes it mandatory to present your financial statement in Naira in Nigeria. However, what if there is no local regulation? The management of the entity is at liberty to determine in which currency it presents. So for bike lights should consider whether there is any local regulation. If yes, it should follow that local regulation. If no, then issue is at liberty to determine in which currency it presents its financial statement, except when the parent company that controls it, which is Cabis, now say, Mr. Backlight, I want you to present your financial statement in what? In this currency. In which case, because Backlight is being controlled, then he doesn't have a choice. So the first thing is there local regulation? If yes, follow it. If no, you are at liberty to choose what you want, unless another person who has power over you insists that you should use a particular currency, which could be your parent company. As simple as that. Adedolapo.
Yeah, good afternoon. I just wanted to help me clarify something. Now you said the first thing the backlash should consider is if there's any regulation that states what currency should be their presentation currency. Yeah. So let's say there's a regulation that says, okay, your currency has to be, let's say, yen. Then you're saying, okay, your their presentation currency is the yen. Then let's say it's a subsidiary to another parent company whose presentation currency is the dollars. So how do they consolidate such accounts since they are going first with what a particular regulation says? They are following what the regulation says should be their presentation currency. So how do they consolidate both accounts?
Okay, fantastic. Fantastic. Two ways. Because assuming that subsidiary operates in China, and China regulation says for every entity operating in our country, it must present its financial statement in yen, then that subsidiary there doesn't have a choice. It must do it in yen. You are now raising a further question that the parent company is based in US, for instance. It needs that financial statement in US dollar. How will it consolidate? That is another discussion entirely. That is another discussion entirely. The parent company that is based in US has two options. He has two options. Option one, he will tell that subsidiary in China that in addition to fulfilling the requirements of the China regulator that requires your financial statement to be presented in here, also present another one for me, for my use, which should be in dollar. Are we together? If that is going to be done, then by that subsidiary must follow the requirement of IS 21 with regards to translating the financial statement of a foreign operation, which is something we have done. Okay, don't let me use that statement generally because I know this class consists of 3 people. Those in the online class, those in the face-to-face class, and those who never received lecture with us. But for the online class, you will testify to the fact that I taught you that. And I want to believe that for the face-to-face class, you can confirm to me that you were taught by Said. But we've done that. So the first option is the parent company in US asks the subsidiary to do another one in dollar for the purpose of consolidation. And the second option is that just leave the subsidiary alone. Pick the accounting record of that subsidiary at the end of the year. Pick that financial statement that is presented in Japanese yen. And you, the parent company, you translate it by yourself when you are consolidating. You translate it by yourself. That is the second option. Adedolapo, does that make sense?
Yes, sir. Thank you.
Okay. Okay, so we've done with presentation currency. Let's go back and now deal with functional currency. Adedolapo, you can lower your hand. With regards to functional currency, are we together? Which is what Martina was trying to explain. Are we together? Based on the requirement of IAS 21 that we all did in the 2 classes, your functional currency is the currency of the primary economic environment where an entity operates, right? Right? That is the definition. And in most cases, but not in all cases, in most cases, that is the currency of the country where an entity is based, but not in all cases. So because not in all cases, we have 3 factors that the standard mentions that should be considered. Number 1, the currency in which your invoice is denominated. The invoice that, the currency that determines the price of the good or services. That is the currency that determines the price of goods or services. Usually, that is the currency in which your invoice is denominated. Number 2, the currency of the country whose competitive forces and regulations influence the sales price of the goods and services. Number 3, the currency in which material costs, labor costs, and overheads are denominated. For item 1 and 3, it could be a mixture of different currency. If you say the currency that influences the sales price, which is the currency of your invoice, invoice may be generated in different currency, which is the case in this question. If you say it's currency of the labor costs, material costs, and other overhead, it may be a mixture of different currency, which I believe is the case in this question. So for that purpose, when it is neither here nor here, because it looks, item 1 and 3 looks like mixture of different currencies, then you are given 2 additional factors, right? The 2 additional factors are 1, the currency in which your fund from operation is retained. Fund you generate from operation, which currency do you keep it with the bank? And lastly, when you are raising finance in form of debt or equity, in which currency do you raise it? Now, in addition to that, when you are looking at the subsidiary of a parent that is based in another country, which is the case with Backlight. Backlight is based in an environment where the currency in use is what? Backlight is based in an environment where the currency they are using there is what?
Dinah.
Dinner.
whereas that of the parent company is US dollar, right? So it says, look at whether that subsidiary, are we together, is an extension of the parent. If it's an extension, a branch will always be an extension. Oftentimes, when you have a branch in America, a branch in Ghana, a branch, not a full-fledged subsidiary, that branch is likely to be an extension because there is nothing that branch is not autonomous. It's not likely to be autonomous. Don't let me use it's not autonomous. It's not likely to be autonomous. And if it's not autonomous, it only sells what you send. It only waits for you to raise finance before it can get money to operate. Everything is dependent on you. That means it's not autonomous. If it's not autonomous, your own functional parent's currency as the parent should be the functional currency of that subsidiary. But if it's autonomous, it doesn't rely on the parent company to send goods before it sells. It can raise money by way of borrowing to pay and to do operations. There is not autonomous. Then you should not use your own currency as the parent as its own functional currency. It should determine its functional currency using those three factors we mentioned earlier and the two additional factors. Now, looking at this, they say Cabot is the parent company of an international group which has a presentation of national currency of dollar. That is the parent. That is the parent. The group operates within the manufacturing sector. 1st January 2022, Cabot acquired 80% of the equity share capital of Backlight, an overseas subsidiary. It's based in overseas. The acquisition enabled Cabot to access, the parent company is able to access to international market, right? Access international market. Cabot transfers surplus, work in progress to Backlight, which is then completed and sold in various locations. What is this one telling you in terms of autonomy of that Backlight? Looking at this one alone, is it showing you that it's autonomous or it's not autonomous?
It's looking like a branch.
It's showing that it's
Looking like a branch, it's not autonomous.
It's not autonomous. It's only waiting for, before it can produce. That is looking at this statement alone without reading to the end. We are going to read to the end. It's only waiting for what the raw material, the work in progress. They say surplus work in progress, right? Whatever Cabot has as surplus to its own local requirement, is what it sends to that overseas subsidiary, which that one will process and complete and sell, right? In various locations. They said the acquisition was not as successful as anticipated. As at 30 September 2006, Cabot disposed of all its holding in Backlight in the current year ended 30th December 2006. Okay, I'm sure there are additional facts here. Backlight is based overseas where the domestic currency is dinars. Staff costs and overhead expenses are all paid in dinars. What does that tell you? You know, the third condition is material costs, overhead, and labor costs, Abi, the currency in which you pay it. But here they single out staff cost, that is labor cost, Abi, overhead expenses, they are all paid in dinars. What happens to material? You know, the material is coming from the parent company, or part of it is coming from the parent company, right? By way of work in progress, right? They say, however, Backlight also has a range of transactions in a number of other currencies. Listen, approximately 40% of its raw material purchase are in dinars. Meaning, what does this tell you, ladies and gentlemen? And 50% in yen. That means what Backlight manufactures, are we together, in form of finished product, does not entirely come from the work in progress transferred to it by the parent company. Do you agree with me, true or false? What it manufactures and sells does not entirely come from the parent company, even though we've seen it at the beginning part of the question, that surplus work in progress is transferred from the parent, which will complete and sell. We are being told here again that when it comes to raw material, 40% are in dinar, which means it buys maybe locally where it is based, because that is its own currency. And 50% in yen, maybe it's import from China. So this guy is perhaps, the remaining 10% are in dollar, of which approximately half were purchased of raw material from Cuba. Hey, you can see that. Only 10% are in dollar. And only half of that 10% is coming from who? Parent. Can you see the conclusion we reached there about autonomy? We need to revise it because we've not seen all the facts then. Additional facts seen now shows that it's only 5%. This guy, in terms of what he produces and sells, is only dependent on the parent to the tune of 5%. Is that enough to conclude that it's not autonomous? No. It's no. The answer is no. Of which approximately 5% were purchased from Kaba. The ratio continues even after Kaba's disposal of his share in Backlight. Are we together? Revenue is so with that third factor, are we together? That third factor, if you put it in, that is the one that talks about material, labor, and overhead. Are we together? If you divide those things in three, material, labor, overhead, are we together? If you say it is condition 3 that we are breaking down into 3 now. Staff cost, they say it's in dinar. Overhead in dinars. Material, are we together? Material, that is 40% in dinars. The other 50% and 10%, they are in another currency. That means you can conclude that that condition 3 support dinar as what? The functional currency. Let's now look at the first condition that talks about the currency that influences the sales price of your good and service, which is what? Which is the currency in which your invoice is usually denominated. It says revenue is invoiced in equal proportion between dinars, yen, and what? Dollars. Hey, 3 currencies, right? That means 33% in dinars, 33% in yen, and 33% in dollars. Remember, condition 3 has supported dinars. This condition 1 is neither here nor there. It's only 33% supporting dinars. Okay? To protect itself from exchange rate risk, Backlight retains cash in all 3 currencies. This is one of the 2 additional factors, but it's telling you that it's retaining in 3 currencies. That means it's neither here nor there. This one too is like 33% supporting dinars, 33% supporting dollar. Okay? No dividends have been paid by Backlight for several years. At the start of 20Xs, Backlight sought additional debt finance. This is another factor, right? One of the 2 factors is source debt finance. As Cabais was already looking to divest, funds were raised from an issue of bonds in dinars. Another factor supporting dinars, right? None of which were acquired by who? By Cabais. Ladies and gentlemen, in solving that part of the question, all we need in determining the functional currency of Backlight, all we need, we've seen it. All we need, we've seen it. Everything we need, we've seen it. Remember, my advice is you should do this analysis, jot it down. Condition 1, currency in which material cost, labor cost, currency that influences the sale price of goods or services, 33% dinars, 33% dollar. Let's forget about yen. Because yen is not that prominent here. Condition 2, currency of the country whose competition and regulatory forces. That one is not even prominent here at all. Condition 3, currency of material, labor, and overhead. That one is about 80 or 90% dinars. Are we together? Currency in which you retain fund from operation. That is 33% dollar, 33% dinars. Currency in which you raise finance, in which you raise fund. We have seen that it's 100% dinars. What will be your judgment and conclusion at the end of the day as to what the functional currency of this backlight should be? What do you think?
Diana.
Dinars. Without doing this proper analysis, it will be difficult to conclude, but we can easily conclude that now that it is dinar. It's dinar. Okay, I believe, wait, what is meant by an entity functional currency? So we've explained that, and we've given those 5 factors. Explain your answer with reference to how the functional currency of backlight should be determined. We've related those definitions, those factors to the question, and we've concluded that it is dinar. We've scored 7 marks. 7 marks. The 2 parts of the question. It's 9 minutes past 1, ladies and gentlemen. Should I do this second part of A? And third part.
Carry on, sir. Carry on, sir.
Till when? Till when? The next class starts by 2, right?
Till 2 o'clock, sir.
The next class.
Till 2, how now? 1:30, please. Next class.
I will stop at 1:30. Ladies and gentlemen, I will stop at 1:30. In 20 minutes time, I will stop so that you can have like 30 minutes. Apology for that. 2 says a calculation of the goodwill on the acquisition of backlight and what the balance would be as at 30th September 2006, right? Immediately before the disposal of the shares. The answer should include a calculation of the exchange difference on goodwill for the period from 1st January 2006 to 30th September 2006. This man now, wow. Was the date of acquisition 1st January 2006? Can somebody help me check that without me going up? Somebody will open the question. Help me check the date of acquisition of backlight. When was it acquired? Check it to your own question.
20x2.
20x2.
1st January 20x2.
20x2. 20x2. What is the year end of this company itself? It's December, right? The year end is December. CO, please pay attention. 31 December 20x2. That is the end of year 1, right? S3, end of year 2. X4, end of year 3, right? X5, end of year 4. Are we together? This guy now says, when you are showing, your answer should include a calculation of the exchange difference. Are we together? On goodwill for the period from 1st January to 30th September. That means we want you to show exchange difference, right? From that 1st January 2022. But in addition, I'm very much interested in the exchange difference that occur between January 2006 and 30th September 2006. That 9 months, I'm interested in the exchange difference. So let's go ahead and see how to go about it. Let me quickly come here and do what we are asked to do, which is calculation. This is A2 now. So you will get the other explanation. I will say, see the other solution. So you will see it there. So 2. calculation of what? Goodwill at acquisition of backlight. Backlight, right? Which is on 1 January 20x2. Hold on. What is the man asking? What am I doing? A calculation of the goodwill on the acquisition. Okay, that is on the acquisition date, goodwill, right? And what the balance will be as at 30th September 20x. Okay, so that is after translation. Ladies and gentlemen, were you told that when you acquire a subsidiary, you know we concluded in the A1 that the functional currency is what? Is dinars, right? When you did group account, IS-21, when the functional currency of a subsidiary is a currency different from the presentation currency of the group. In this case, functional currency of backlight is dinars. Presentation and functional currency of the group is dollar. What were you told with regards to calculation of goodwill? In which currency should it be calculated? Remind me. In which currency? In which currency?
Subsidiaries currency.
In that subsidiary functional currency, that is the currency in which it must be calculated first. That is the currency in which it must be calculated first. So dinars, that is millions. Let's do it in millions. Are we together? To calculate goodwill is very simple. You need 3 items. Fair value of consideration, right? Of consideration given, right? The second item is NCI, depending on whether we are using fair value or proportion of net asset method. Okay, Cabas pay 100 million dinars. That is the consideration for 80% of the ordinary share capital of Blackland first day. The net asset of Blackland this day had a carrying amount of 60 million, right? That is the book value of the net asset, right? The only fair value adjustment deemed necessary was in relation to building, which had a fair value of dinars of how much? 20 million. So that is an upward fair value adjustment that will be added to the 60 to get what? 80. So when you get 80, it becomes the fair value of the net asset of the subsidiary at the date of acquisition. Above its carrying amount and a remaining useful life of 20 years. That means after that day, we will depreciate, right? Come back there. Cabas measures NCI at fair value for all acquisitions. And the fair value of the 20% interest was estimated at 22 million. Due to the relatively poor performance, it was decided that to impair goodwill by 6 million during the year ended. That was the 4th year, Abi. 2, 3, 4, 5. Yes, impairment occurred in year 4. Fantastic. We'll deal with that, but what they're asking for now is goodwill at the date of acquisition. So we are using fair value. Fair value of NCI at acquisition date. Okay, so the consideration, if you are looking at your question, without me going back, what is the fair value of the consideration again? It looks like 100 million, correct me.
100
based on what we saw.
100 million.
100 million.
Okay. The second thing is fair value of NCI at acquisition. I think I saw 22 million
22
then.
million.
Okay. So the summation of these two figures is what? Then we now say fair value of what? Net assets of sum at acquisition date. And that is, initially the book value of the net asset was how much? Before considering upward fair value. How much?
60 million.
60 million.
Times 20, right? Upward fair value adjustment is 20.
Yes.
So we say equal minus, remember we want to remove it. 60 plus what? 20. I'm sure this still looks simple, right? Up to this point is simple. Yes, that is how simple it will be till the end. So goodwill on acquisition, are we together? Goodwill
Not
on
taking the,
acquisition.
sorry, sir. Are we not taking account of the depreciation? It's a building.
Remember, what you are talking about affects net assets after the acquisition date, not at the date of acquisition. Will you charge depreciation at the date of acquisition, Martina?
Okay.
Or you will charge depreciation between the date of acquisition? You will not charge goodwill at acquisition date. You will charge it between acquisition date and reporting date. So goodwill at what? Acquisition date. Are we together? At acquisition date. So that is what the man asks. Remember, that is what he first asked. So we've done part of what he asked in that bit, in that 5 months. But we've not done everything. Say a calculation of the goodwill on the acquisition of backlight. We have done that now. That is 42 in dinars. We can translate it to dollar if we have exchange rate as at that day. But we'll do that here. And what the balance will be as at 30th September. For this man to be asking what it will be, ladies and gentlemen, what were you told with regards to goodwill? When you calculate it in that foreign currency, what did I tell you in case I told you? Or what were you told in case I did not tell you about goodwill translation? What were you told about it?
Spot rate and the date of acquisition?
Using, yeah. And then
At
after
the end
closing
of
date, use the
each
closing
reporting
rate.
period, at the end of each reporting period, it should be translated using exchange rate as at that date, right? Which means first, at the date of acquisition, you will translate using exchange rate at the date of acquisition. Then subsequently, at the end of each reporting period, you'll be doing that translation, right? I get it. Okay.
Yeah.
So let me go and do something. Let me go and do something. So this is still a continuation of A. So I want to say translation of goodwill that arose on backlight between acquisition date, which is 1/1/20 X2, right? And the date and 30th September, right? That is what the man says now. 30th 9 X6. That is what the man is asking for, 20 X6. So it's a long journey we want to embark on now. But we will shorten it. We will shorten it. You will see. We will shorten it. 6. Okay. I will create a column here for diners. I will create a column here for what? Dollar, currency dollar. I will now say this middle column is what? Exchange rate. ER stands for what? Exchange rate. Are we together? Okay. Let's start our goodwill translation. I will say goodwill at 1 January 20x x what? X2, right? You know the goodwill amount as at that day is 42 dinars, right? I will use currency D. I will use D for dinars, 42 million, right? Divided by what? We'll first translate it to dollar using exchange rate as at that day. What was the exchange rate as at that date?
0.4.
0.5 dinar to $1.
I want to see it. 1st January 2022, 1.05, right? 1.05. Okay. Divided by 0.15. Do you agree with me that I should divide? You agree with me that it's a division, right? So I will put the dollar amount here. Sorry, the dinar amount here. I will now put the exchange rate here, 0.5. Then I will say this figure. Are we dividing or we are multiplying?
We are dividing.
We are multiplying.
We are dividing. No. We are dividing.
We are dividing.
They say $1 equal 0.5 dinars.
Something for multiplying. Okay, 0.5.
Dinar is stronger now. Dinar is stronger in this case.
Dinar is stronger than dollar.
This must be dinar that is being spent in the moon. It must be the only one that is stronger than dollar. But it's stronger. You can see that it's stronger here. It's stronger because 0.5 dinars make $1, right? That means when you want to translate that dinar to dollar, you should divide. Are we together? Even if they say 2 dinars make $1, are we together? Translating it, you will still divide, right? You divide by 2, but this time around is divided by 0.5. So we say this figure divided by this. Are we together? Yes, that is 84. Are we together? So that is 84. Then, ladies and gentlemen, ideally we should be doing it at the end of every year. So I should leave a space. Are we together? I should leave a line. Then I will now say goodwill as at 31 December 20S2. Are we together? I will translate in using exchange rate as at 31 December 20S2. Then the difference between that goodwill translated and the one at the beginning, which is 84, will give us the exchange difference. Then we'll do the same thing for 20S3. We'll do the same thing for 20S4. But you can only do that when exchange rate at the end of S2 is given. Exchange rate at the end of S3 is given. Exchange rate at the end of S4 is given. And exchange rate at the end of S5 is given. That is when you can do it year by year. Let's go back to where we were given the exchange rate. After 1st January 20S2, which one do they give us next? Tell me here.
X5.
X5.
You can see they did not give us as at S2, as at S3. Sorry, end of S2, end of S3, end of S4. We were not given. So that means don't bother to look for exchange difference in those years. We were not given, we only give average for 20S5, average for 20, at the end of S5, then as at 30th December 30th September 20S6. So we will do it as at that 31 December 20S5. Don't forget, it's $1 to 38 dinars, 0.38 dinars, $1 to 0.38. So see what I'm going to do now. See what I'm going to do now. But there's an impairment loss, so yeah. What do they say? There's an impairment loss, right? Can you see impairment loss?
6 million.
During the year, which year? That year ended 31 December 20X5, right? Ladies and gentlemen, when it comes to impairment loss on goodwill, which exchange rate do we use to translate it? Do we use exchange rate at the end of the year, or do we use average rate for that period? I want to hear your view.
Average rate. Average rate.
No, I disagree. At the end of the year.
It is average. Why is it average? The other leg of that impairment, where does it go to? P or L? Anything that goes to P or L, even though the other leg affects an asset or liability, we use average rate. Anything that affects P or L, even though the other leg of that anything affects liability or asset, we use what? Average rate. Take note of the average rate. 0.4 to what? $1. 0.4. So I would say impairment loss for the year ended 31 December 20X5. So that figure is what? 6, right? 6 million, right? Divided by what? Again, I've forgotten. 0.4. 0.4. Talk where your hand is up, or you've lowered it again. So I will say here, I'm going to remove -6. But here, my exchange rate is 0.4, right? And here, what will I do? I will say this figure divided by this figure. That gives me -15, right? -15. -15. -15. So, you know, we've not translated now. We've not translated as at 31 December, right? We've not translated as at 31 December. I will now leave a line for exchange difference on goodwill. There won't be exchange difference in the column of dinar, right? Exchange difference will only come in the column of dollar. So I will now say goodwill at 31 December 20X5. And goodwill as at that day in currency dinars is what? 36 million. 36 million, right? Divided by exchange difference at the end of that X5, which is 0.38. You've seen it as 0.38, this figure, right? 0.38. I'm supposed to put a line here. Oh, no, I put it in the wrong place. It's here. Okay, then there will be another one here now. So here is 36. Exchange rate here is 0.38. And when we divide it, this figure divided by this, 2 decimal places, I bet. Okay. Okay. Then balancing figure. There is no exchange difference in the first column of dinars. The balancing figure, ladies and gentlemen, you see that I'm going to get this place as a balancing figure. Difference between 94.74 and 69 that we have here is the balancing figure, which is 25.74. That is exchange difference on goodwill. Is it a gain or is it a loss? Tell me. That 25.74, is it an exchange gain or is an exchange loss?
Again.
Again. Okay.
How is it again?
It's an increase. Increase in an answer. You can see it increased from 69 to 94.74. Can you see that it's positive? Positive in an answer means is increasing it. Is that correct? Increase in an asset is a gain. Increase in an asset is a gain. So this is as at 31 December 20x5, which is the same thing as the beginning of 20x6, right? This man said he's interested in the exchange difference that occur in this year. So remember, we did not get to 31 December 20x6. They said we should stop at 30. So I will now say goodwill. No more impairment, right? Goodwill at 31 December 20x6, which is still going to be 36, right? 36D in millions divided by what is exchange rate as at 30th September. I want you to call it out. 30th September.
0.35.
0.35, you've seen it. 0.35. K divided by 0.35. So no exchange difference here, but here's 0. Oh, sorry, I'm coming. 0.35. So what I'm supposed to do is to put 0 here. This is going to be exchange difference. Exchange difference on goodwill for the period ended 30 what? 9x6. This one is exchange difference on goodwill between 1 X2
rate.
So
it's not for September.
You said?
The exchange rate we are using is not September.
It's 30th September.
September
That's
20x6. Okay, because you're in December down there.
No, it's not December. It's not December. To 31 12 x5. Man did not say December. I'll look at the requirement again. It says up to
Your solution, sir.
September.
In your solution, you put December. That's what we're saying.
Oh, sorry. 30 September 20x. But it's 0.35, you agree, right? That is 0.35, right? Okay.
Yes, I agree, sir.
So this is where we are stopping it, right? This is where we are stopping it. And but this one, so we translate 36 divided by 0.35. Okay. The thing keeps on increasing. It keeps on increasing because of the depreciation of dollar. So exchange difference here is going to be a balancing figure as well. This minus this. 8.12, as simple as that. That is what the man asked us to do here. But did this just say we should calculate? The man did not just say we should calculate. What did he say we should do? This man said we should calculate, and do what? Explain. Did he not say we should explain? Oh, he never said so. A calculation of goodwill at the acquisition.
The
What balance
explanation
would
is the next one.
the answer should include a calculation of exchange difference on goodwill. Okay, we just got 5 marks. Just got 5 marks. An explanation of your calculation of goodwill and the treatment of exchange difference of goodwill in the consolidated financial statement. You do not need to discuss how the disposal will affect performance. Very cheap. So the calculation we've done in 2 is what they want us to explain. I think I've exceeded what I told you by 8 minutes. What I'm going to do is that in this same Excel, I will finish and send to you. I will finish and send to you. In fact, I have it in the Excel because I've done it before. I thought okay. So that will be the end of today's class. I will finish and send to you. I will finish and send to you. In fact, I will insert some comments here so that when you see them, this impairment loss, how should it be treated? I will start a comment here. This exchange difference here, how will it be treated? I will start a comment here. And this one, how will it be treated? So, and I will leave those comments in a way that when you open in Excel, you will see them. Any question, any query?
Yes, just a brief question. I believe that this is our last class. And when are we going to treat the mock debrief?
A day, a separate, I think Monday, from what I heard, Monday. Have you all done the mock? Have we all done the mock, please? Have we submitted?
I've done some mocks. They have marked for people that have submitted. We that we did not do, are waiting for the brief, sir.
Seconded.
Wait, the question, why did you not do it? You still believe you were not ready, right?
No, we were doing for other papers, and I forgot.
Why did you not?
Circumstances beyond our control.
We're not ready.
No, when you are determining foreign currency, functional, you have to look at many factors. So those factors.
Wait, hope the question in the mock is not these questions we've been solving. Because I didn't see your mock question. No.
Yeah,
Is it?
I don't think so. No, sir, it's not.
No, it's not. Yes, sir. Unfortunately, I did the mock, but I didn't know how to save it.